September has a reputation. It's the month that breaks portfolios. But this time, something unusual is happening. Small caps are breaking out. Tech is flashing weakness, and Bitcoin can't seem to follow through. Buried inside all this noise, my hidden market monitor signal just flipped, and it could decide whether September ends in a clean breakout or a brutal shakeout. Stick around, because in this video, I'll break down every major market index, and at the end, I'll show you guys the exact signal that could flip the entire market. Welcome back to the Stock Operator channel. I track my $100,000 portfolio I've created for my newborn son live every week. And today we're doing a full market breakdown. IWM, S&P 500, QQQ, Bitcoin, gold, and Ethereum. And at the very end, I'll show you guys my proprietary market monitor. This is the same tool I use to hedge, rotate, and time my moves. And right now, it's flashing something I haven't seen in months. So if you guys want to stay ahead of the September flip instead of reacting after the fact, hit that like button, subscribe, and watch till the end, because that hidden signal could decide how the rest of the month plays out. Let's start with the Russell 2000, ticker symbol IWM, the small caps. If you zoom out, you'll see this massive structure that's been building since 2021. It's like a coiled spring. Years of frustration, false breakouts, endless sideways chop. But now look at it. The right-hand side of the chart, this is a textbook shakeout, followed by a surge towards new highs. Here's why this matters. When rates fall, small caps usually breathe easier. Lower borrowing costs mean these companies, which rely heavily on credit, suddenly get oxygen. That's why, despite all the doom and gloom about the economy, small caps are quietly acting bullish. Think of it this way. From 2021 to 2024, the economy looked strong on paper, but small caps lagged. Now, employment's softening, growth is wobbling, and suddenly IWM is leading. That's a reversal of the usual script. On my chart, I've drawn out key breakout levels. We've already cleared the top from the 2021 range. The only thing holding this back is a little bit of supply. See that candle with the small body but a massive wick? That's sellers trying to push back right as demand is coming in. This is where it gets fascinating. If the Fed cuts in September and the market's already pricing that in, that could be the final catalyst to blast the IWM to all-time highs. But here's the open loop I want you to be thinking about. What if this supply zone doesn't give way? What if this candle marks the last gasp before another shakeout? Personally, I'd like to see a quick fake out and flush lower before a breakout, because that would trap shorts and fuel an even stronger rally. Either way, IWM is telling us small caps are in play, and if you've been ignoring them, you might be missing the quiet leader of this entire market. Now let's turn to the S&P 500, the index that everybody watches. On the surface, it looks like a dream, new all-time highs, a clean breakout, headlines celebrating strength, but dig deeper and the structure tells a very different story. Look at these waves. Each push higher, each up wave is getting shorter. The market is still climbing, yeah, but every stride is smaller than the last. It's like a runner near the finish line. They're still moving forward, but you can see the exhaustion in every step. Now here's the red flag. Last Friday's candle, for the first time in months, supply showed up at the high end of the range, not at the lows during the pullback. But right when the S&P 500 pushed into new territory, that's the market saying, hey, we're running out of buyers up here and supply is coming in. Historically, when you see traps form, a breakout on weak demand can turn into what we call an upthrust, a false rally that reverses hard. If this level fails, it could trigger a fast unwind because so many traders have piled in thinking new highs equals safe. But here's what makes this fascinating. The S&P 500 is still making higher highs and higher lows. So bulls will argue this is just a pause, where bears will say this is distribution. Who's right? We'll know if the S&P 500 can reclaim the close above Friday's high. That's pretty much the line in the sand. All right, now let's talk about the QQQ, the tech index, the so-called market leader. Here's the problem. Leaders aren't supposed to stumble, but QQQ just flashed one of the weakest patterns I've seen all year. Instead of printing a higher low like the S&P 500, it only managed an equal low. That's not strength, that's hesitation, lack of demand. And look at this last upwave. It had the highest volume of any rally we've seen recently. Normally, you want to see volume confirm strength, but in this case, volume spiked into the highs. That's not conviction, that's distribution. That's supply coming in. Imagine a crowded party. The room is packed, music's loud, energy's high, but suddenly everybody starts heading for the exit at once. That's what distribution looks like at the chart. The surface looks fine, but underneath, the smart money is already slipping out the door. Now, if the QQQ, the index that usually leads bull markets higher, is lagging with small caps breaking out, that's a classic sign of rotation. Money isn't leaving the market entirely, it's leaving tech, large cap tech. And when that happens, the overall market tends to wobble because the heavyweights like Apple, Microsoft, and Nvidia stop carrying the bag. So if you had to pick right now, would you hedge with QQQ puts, or would you bet that big tech snaps back and continues higher? Drop your answers in the comments below and I'll feature some of the takes on next week's update. Now let's dive into two assets that everybody loves to argue about, Bitcoin and gold. All right, first, Bitcoin, after building a massive base for months, almost 6.5 months, it finally broke out. Traders expected fireworks, 20, maybe 30% upside. What did we get? A measly 10% rally into all-time highs before momentum fizzled out. That's like training for a marathon for an entire year and collapsing after the first mile. Here's why that's dangerous. Breakouts that fail to deliver usually aren't neutral, they're traps. And when a breakout this big stalls so quickly, it tells me demand just isn't there. In fact, the longer Bitcoin chops sideways at these levels, the more likely it morphs into an upthrusting structure, a fake strength setup that flips into weakness. Now, let's contrast that with gold. Gold had a much smaller base, just 4 months of consolidation, and it's already delivered a clear 6% rally into the all-time highs. That's conviction. That's what you want to see after a breakout. Buyers stepping in, miners confirming, and the move holding above key levels. Here's the psychological difference. Bitcoin right now feels tired. It's like everybody's waiting for the next big run, but the spark isn't really there. Gold, it's quietly doing its job. No hype, no drama, just grinding higher with strength across the board. So ask yourself this, if big money has to choose between a flashy asset that's stalling and a steady asset that's confirming strength, where do you think the capital will flow? Now, let's talk about Ethereum, and this one's a little more tricky. On the surface, Ethereum looks much stronger than Bitcoin. It's been pushing towards highs, it's showing demand, and it hasn't broken down. But look closer, and the structure is far from ideal. Here's the issue. We just saw a massive momentum candle, big surge, heavy volume. Normally, that should ignite a breakout. Instead, the price stalled for 10 straight days. Ethereum has gone sideways, no follow-through, no conviction. That's a big red flag. Think of it like this. Imagine a rocket lifting off the launch pad. Engines roaring, flames shooting out, the whole crowd is cheering. But then, just a few hundred feet up, the rocket hovers, suspended. Everybody's waiting for it to soar high, but gravity is pulling down. That's Ethereum right now. So what's next? Two paths. Either the bears push it just under this momentum candle, shaking out everybody who bought that breakout. That would trap traders and create fuel for a real rally. Or, number two, demand steps in back immediately and Ethereum rips through resistance without the shakeout. Either way, the structure is too obvious. And when a setup looks that clean, markets usually punish the crowd before rewarding them. All right, let's shift gears and look at something I rely on more than any single chart. It's my market monitor. Think of it as the market's heartbeat. It doesn't just track one index or coin. It measures the flow of risk, the rhythm of cycles, and when momentum is about to flip. And right now, the market monitor is green. Sounds bullish, right? But here's where it gets interesting. The average green cycle lasts about 12.8 days, and it makes about a 3.7% move. This one, it already feels tired. It's like a sprinter at the start of the line who looks ready, but you can see the fatigue in their eyes. I don't think this one makes it to the finish line. Now, let's break down some internals. Stage analysis. 61% of stocks are in uptrends, stage 2, 22% are still stuck in downtrends, and the rest are either basing or rolling over. Translation, the breadth is there, but momentum is missing. It's like the team's on the field, but nobody's scoring points. The VIX sitting at 15, normally bullish, but here's the catch, correlation is also at 15. That means that everything is moving together. And when markets move in lockstep, reversals get violent and downtrends happen. Imagine a crowded theater and one person yells fire, and that gets the entire room to bolt at once. So some momentum indicators, short-term momentum is actually turning down, even as the cycle reads green. That's a dangerous divergence. So here's the takeaway. The market monitor may look healthy on the surface, but under the hood, it's sending mixed signals. Green light, tired legs, breadth without thrust, calm volatility masking high correlation. And that's why September could flip fast, because the next move isn't about whether the market looks strong or weak. It's about what happens when everybody realizes they're all on the same side of the boat. So here's the bottom line. Small caps, the IWM, are acting like stealth leaders, ready to break out if the Fed cut hits in September. The SPY is grinding higher, but every stride is shorter, and Friday's supply candle could be the warning shot. QQQ and large cap tech, flashing signs of distribution. If leadership cracks, the whole market will feel it. Bitcoin looks tired, a breakout that fizzled. Gold looks clean, strong, and confirmed uptrend. Ethereum sits in no man's land. It's kind of the wild card. And my market monitor, green on the surface, but under the hood, it's flashing some caution. So what does this all mean? September might not just be another month. It could be the month where the cycle flips, a quiet breakout or a shakeout that clears the board. And that's why in my $100,000 portfolio, I'm staying selective, keeping hedges on, and waiting for the market to tip its hand, because when it does, the move could be sharp in either direction. Now, I want to hear from you. Do you think this September ends with a clean breakout or a brutal shakeout? Drop your answers in the comments and I'll feature one of the comments at next week's update video. Oh, and speaking of next week, I'll show you whether my QQQ put hedge paid off and reveal the one small cap I believe could quietly double if this breakout holds. So make sure you subscribe, hit the notification bell, and I'll see you guys on the next one. Cheers.